Hey everyone, and welcome back to The Explainer. I'm so thrilled you're joining us today because we are tackling something absolutely huge for your financial future. We're looking at the ultimate wealth building showdown: index funds versus mutual funds. Let's get right into it. If you're on any sort of wealth building journey, or even if you're just starting to think about putting your cash into the stock market, you're going to face a major crossroad right off the bat. Do you go with a mutual fund or an index fund? Well, today we're going to break down exactly why you need to stop paying high fees for low returns right now. Are you paying Wall Street to lose your money? Now I know, that sounds a bit harsh, doesn't it? Kind of sounds like a trick question. But as we unpack the data today, you might just find that this is exactly what's happening with your current investment strategy. If we aren't careful, the system is quite literally designed to slowly siphon away our hard-earned wealth. Part 1, the active management myth. You know the drill. You start investing, and financial advisors often push you right into actively managed mutual funds. It's the classic default advice for so many folks. But what are they actually selling you? The Wall Street promise is super enticing. First, they tell you you're getting professional fund managers, absolute experts, watching your money. Second, these experts are doing extensive market research every single day. Third, because of all that research, they're going to handpick the winning stocks for you. And finally, the ultimate goal of all this effort: they promise to beat overall market returns. It sounds incredible, right? Like, why wouldn't you want a team of highly paid pros navigating the market to get you better returns than everyone else?
Part 2, the truth about returns.
Okay, let's look at the actual data here, because the truth tells a vastly different story than those glossy marketing brochures. We really need to shatter this superstar fund manager myth right now, because the numbers just do not back up the promise. Just look at the reality staring us in the face right now. A massive 90%. Over a 15-year period, more than 90% of actively managed funds actually fail to beat the simple S&P 500 index. 90%. Just think about that for a second. More than 9 out of 10 of these elite, highly paid teams with all their research and active stock picking literally cannot even beat a basic index that simply tracks the market automatically. They're charging you a massive premium for a service that the vast majority of the time just totally fails to deliver.
Part 3, how fees destroy wealth. So, if they aren't beating the market, what exactly are they doing? Well, they're charging you. And that brings us to the core factor driving this massive underperformance: the silent killer in your portfolio. The big difference between a mutual fund and an index fund really comes down to this one crucial factor. Mutual funds rely on those expensive analyst teams we just talked about, meaning high overhead, which translates to a 1% to 2% annual fee. Contrast that with index funds. No expensive humans guessing the future, it's just automatic computers passively tracking the market. Because there's zero active management needed, index fund fees are near zero, often as low as 0.03%. You're comparing a 1% or 2% fee to basically a rounding error. Now, you might be thinking, okay, a 1% or 2% fee, that sounds tiny. What's the big deal? Well, the big deal is lost compounding power. This is the exponential loss of potential future wealth caused by recurring investment fees just slowly eating into your capital over time. Think of it like this. Your investment account is a giant bucket catching rain, right? That's your compounding wealth. A 1% or 2% fee is a massive, gaping leak at the bottom of that bucket. Because that money gets siphoned out every single year, it's not there to grow and compound next year or the year after that. And let's look at exactly how much water is leaking out. 30 to 40%. Seriously, over a 30-year investing timeline, that single difference in fees, just that seemingly tiny 1% or 2%, can literally eat away 30 to 40% of your total wealth. That is staggering. Let that sink in for a minute. You take all the risk, you put up all the capital, and Wall Street skims off almost half your lifetime returns just for the privilege of underperforming the market. That's exactly how fees silently destroy your long-term wealth. Part 4, the index fund advantage. Now, let's pivot to a much more empowering, data-backed solution. We've seen the wealth destruction of active management, but there's a much smarter way to build your financial future. And hey, you don't just have to take my word for it. The legendary Warren Buffett consistently gives this exact advice to everyday folks. He says, invest in low-cost S&P 500 index funds instead of paying high fees to Wall Street managers. Period. When arguably the greatest stock picker in history tells you not to pick stocks, and definitely not to pay Wall Street to do it for you, we should probably listen, right? The math is clear and the experts absolutely agree. So what's our actionable playbook here? The smarter path forward is basically 2 really simple steps. Step 1, stop paying professionals to underperform.
That 1 or 2% fee is mathematically wrecking your future wealth for a service that fails 90% of the time. Just completely scratch that. Step 2, buy the whole market via low-cost index funds. By passively tracking the entire market with fees near zero, you're guaranteeing you capture the market's natural growth over time without dragging all that heavy Wall Street overhead along with you.
Keep those profits in your own pocket, right where they belong. As we wrap up this explainer, I want to leave you with one final, pretty provocative question to think about. Who is really getting rich off your current investment strategy? Because if you're paying 1 to 2% to a mutual fund manager who is failing to beat the S&P 500, it sure isn't you. It's time to stop paying those useless fees and start building real, long-term wealth. Thanks so much for hanging out with me today to break this all down. Take a hard look at your own portfolio, and I'll catch you in the next explainer.